Copart stock has dropped over 38% since the highs in May of 2025. And in this video, I'm going to go through their company moat, their business model, and look at their key financial highlights, their financials, their earnings. They recently reported earnings in November. So I'm going to go through those and see if I can get any information about whether this is a good investment for long-term value investors. So if you like this content, please like and subscribe, and let's get straight into it. So what does Copart do? Their business revolves around the fact that they provide vehicle sellers with a full range of services to process and sell vehicles, primarily through the internet, through their virtual bidding third generation internet auction style sales technology. So they are basically a vehicle auctioneer. They sell vehicles through online, and they refer to that technology as VB3. Now, these vehicle sellers consist primarily of insurance companies, but also include banks, finance companies, rental car companies, charities, fleet operators, dealers, and individuals. So they have a large variety of vehicle sellers that sell their vehicles through their technology online. And you may be asking, how does Copart, profit from all of this selling? So as these vehicle sellers sell through their technology, Copart gets transaction fees for all of these transactions that are happening. Now, if we look at their investor relations homepage, we can see some of the numbers that management is highlighting. And you can see vehicles available online every day is 265,000 plus. They have 3 million plus vehicles sold per year. Countries that we have buyers in, 190 plus. They are international. They have a huge market. They are a leading company for vehicle auctions and remarketing services. So you can see that they're international in that effort. They have 250 plus locations, and they operate in 11 countries. So they're pretty broad and large organization. They've been around since 1980s, 1982, but they really proliferated with the online selling and auctioning. So they've used this technology to really scale and become bigger. And you'll see in their margins later that it is a higher margin business, higher than their competitors in this space, because they are able to leverage this technology. Now, if we go to Fiscal AI, and the link is down below if you want to get access to Fiscal AI. Fiscal AI does a great job of breaking down a company, their analytics, their financials, their metrics. So I'm using them to analyze Copart here. And you can see that in the description here on Fiscal AI, they operate in United States, Canada, United Kingdom, Brazil, Ireland, Germany, in Finland, the UAE, Oman, Bahrain, Spain. So many countries they operate in, and that gives them that is part of their wide moat in this business, in this industry, because they're international. They're not relying on any particular country. They have a little bit of geopolitical shield because of that. One country goes down, another country may be fine. So here, their international presence is a plus, and it adds to their moat in this industry. They offer a range of services of processing and selling vehicles over the internet through their virtual bidding software, VB3. So you may be wondering who's buying these vehicles from all these sellers through their technology. And so this line speaks to that. They are licensed vehicle dismantlers, rebuilders, repair licensees, used vehicle dealers, exporters, and so they're headquartered in Dallas. And so looking at the company statistics in general, here you can see their market cap is about 37.73 billion. Enterprise value is about 32.61 billion. The difference here is their debt. So you can see they have about 5 billion in debt. Their shares outstanding stands at 968 million, and I'm going to get into whether that is going up or down. We want to see share buybacks, because as a value investor, as a long-term value investor, you want to see shares outstanding go down over time through share buybacks, but only if the company is undervalued or seemingly undervalued. Because if the management is buying shares back at a high price or a high valuation, then that signals that the management is not skilled enough to know when the company is undervalued versus overvalued, They're buying at the wrong time and the wrong price. They make yearly revenue of 4.66 billion, and they have about 13,800 employees. Now, like I was saying before, their margins are really excellent because they're leveraging technology, they're leveraging their VB3 software. So here you can see their gross margins at 47.6%, which is a lot higher than their competitors. EBITDA, 42.5%. Operating margin is 38.2%. Pre-tax is 41.5%. Net margin is 34.2%. And free cash flow is 30.3%, which is really high. The return on assets is 19.4%. And return on equity is 22.7%. These are really nice numbers. Return on invested capital is 31.1%. So these are really high numbers, and that's a really high return on invested capital. EE stands at 23.9. Price to book is 3.9. EV to sales 7. EV to EBITDA 16.5. Price to free cash flow is 26.7. So analysts are anticipating a price target, 1-year price target, next 12 months, of $49.67, which is about $10 above the current price. The PEG ratio is 5.8. So that's something I don't like. That seemingly says that this company is overvalued if you're just looking at a PEG ratio. Usually you want a PEG ratio close to 1 or ideally under 1 to indicate that the company is undervalued, that the growth prospects are going to be higher than the PE ratio, which indicates that you may not be getting the best value when you buy this company based on just the PEG ratio. EV to sales is 6.8, EV to EBITDA is 15.8. Cash on hand is 5.24 billion. That is good. Net debt is negative 5.14. Their debt is 5.14 billion. So debt to equity is 0. Now their CAGR rates for 3-year, 5-year, 10-year is around 10 to 15%. So let's go through their bull and bear cases here. So bulls say, and I really like this feature right here on Fiscal AI, they distill what bulls are saying and what bears are saying so you can get a full picture of what's happening with this company. The bulls are saying we see Copart's wide moat as safe given minimal competition and an excellent ability to provide a high liquidity marketplace for buyers and sellers. Copart's balance sheet looks to be in great shape, and we expect buybacks as well as acquisitions. The latter is often more likely to help fuel stock price growth over time. And this is true for a lot of companies that I'm investing in. Things like Tidewater. The management has specifically stated that acquisitions are a bigger priority than buybacks because in certain industries, for example, Tidewater's industry, there is a huge lead time in building boats and vessels, and it's very costly as well. So the management has astutely looked to acquisitions to grow their fleet rather than building boats to build their fleet up. And by doing that, they also minimize the competition that they face in the industry. So I'm thinking that's what's happening here with Copart, where if they do acquisitions versus buybacks in priority, then they'll be able to keep their competition low and also grow their revenues and stock price growth over time because they will be able to be the only, almost like a monopoly in the space. But as those revenues, earnings grow and free cash flow grows, that gives them the leeway, the leverage to do those buybacks, to increase buybacks, to authorize a large buyback in the future. Copart's auction volumes should rise long term as used vehicle pricing caused by the chip shortage comes down while repair costs should remain high. So here they're saying that vehicle complexity is only increasing. So repair costs go up and up and up. And you've seen that over, decades. It used to be back in the 70s, 60s, 70s, 80s. These cars and vehicles were a lot less complex than what we have today with all of these more complex features that are put into these newer cars. So what they're saying is the repair costs for these cars should be very high, for these modern cars should be very high. So they're saying these factors should encourage insurers to total more vehicles than in recent years after the pandemic and chip shortage. So those are the bull cases, but let's go through what the bear cases are. So they're saying that Copart's moat could be weakened should RB Global meaningfully improve IAA following its March 2023 acquisition, which may be occurring now. So this might be a shorter term thing in the near future. German market growth could take time as title transfer laws are different and more cumbersome than in the US. And if cash keeps constantly piling up, it begs the question of when will it be spent and will shareholders get any of it? I'm going to add another bear case to this, and that is what happens when autonomous vehicles get more mainstream, such as Waymo. You're seeing Google's Waymo being introduced more and more and more. And those vehicles are not going to be sent to Copart or sold on Copart because they are part of a fleet. They're part of an autonomous vehicle fleet. And Google is going to be handling the maintenance and repair of those vehicles. They're not going to be sent through this auctioning or this remarketing vehicle technology. Same goes with Tesla's autonomous fleet when that gets going. Same with Zoox when Amazon really scales that out. So if the future is autonomous vehicles, I'm a little bit hesitant to talk about Copart's wide moat. And this is a bear case, but we have to really look at what the future of autonomous vehicles is. And that could really be a disruptive factor in Copart's industry. Okay, so let's get to their financial results. They recently reported on November 20th. And so here in their letter, they said for the 3 months ended in October 31st, 2025, revenue, gross profit, and net income attributable to Copart Inc. were 1.16 billion, so that's revenue, 537 million for gross profit, and 403.7 million for net income. These represent an increase in revenue of 8.2 million or 0.7%, so super low growth, an increase in gross profit of 24.9 million or 4.9%, and an increase in net income of 41.6 million or 11.5%, respectively, from the same period last year, so year over year. Fully diluted earnings per share, EPS, for 3 months ended October 31st, 2025 was 41 cents compared to 37 cents last year, an increase of 11.7%. It's pretty low year over year growth in revenue. So looking at their statement of income here, you can see their services revenue was 991.845 million, a 0.6% change. Their vehicle sales was 163.185 million, a 1.7% change. So their total service revenues and vehicle sales was 1.155 billion, which is only a 0.7% change year over year. After operating expenses, their gross profit came in at 536.998 million, which is only a 4.9% change. And the operating expenses, they broke down to facility operations being the majority of it. On the plus side, they dropped their facility operation expenses about 4.5%. Cost of vehicles went up to 2.4%. Facility depreciation and amortization went down 0.2%. And facility stock-based compensation went up by 6.1%, even though the actual number was pretty small. G&A was 92.268 million, which is a 1.4% increase. Depreciation and amortization went up 8.2% to 6.652 million. So total operating expenses was 724.336 million, which is a drop of 2.2%. And operating income came in at 430.694 million, which is an increase of 6%, which is good. So net income came in at 402.210 million, which is an 11.4 increase over the last year. 41 cents versus 37 cents, which is 11.7 increase. So you can see that their cash and cash equivalents came in at 5.233 billion, which is great to see. Their total current assets is 6.2 billion, and then total assets came in at 10.581 billion versus 10.09 billion. So total liabilities came in at 961.9 billion. Total liabilities redeeming non-controlling interest and stockholder equity has to equal or match the total assets. So let's look at their cash flow statement. Here they're starting with their net income of 402.21 million. So adjustments to reconcile net income to net cash provided by operating activities. They have depreciation and amortization, including debt cost, was 54.199 million. Stock-based compensation was 9.319 million. Now, I like that it decreased year over year, but you would ideally like to see no stock-based compensation, SBC, because it dilutes shareholder value. Gain on sale of property and equipment, which is negative 1.128 million. Deferred income taxes, 5.9 million. And then changes in operating assets and liabilities, all that together, you get net cash provided by operating activities as 535.253 million. Cash flows from investing, the net cash provided by investing activities, $1.916 billion. So cash and cash equivalents at the end of the period was $5.233 billion versus $3.698 billion a year ago. So a big increase in cash and cash equivalents year over year. The United States accounted for most of their service revenue at 855.534 million, vehicle sales at 97.08 million. So operating income came in at 374.972 million in the United States and 55.722 internationally. Now let's go back to Fiscal AI to look at the metrics and whether this is a good investment. So I'm looking at their income statement historically, and revenues trend upwards. It's been trending upwards. The cost of sales increase as well, but not as much as revenues. Gross profit has been going up. Gross profit margin been pretty steady in the 40s, higher 40s. Selling, general, G&A expenses have been going up, which is not great. Operating profit has been going up slowly, but that's good. Operating margin's been seemingly steady in the 30s, high 30s. The EPS is going up over time. Now, this is what I don't like to see. So this is why I was concerned about stock-based compensation, because you can see that their shares outstanding, the total shares outstanding, has been going up, not down. That's not what we want to see. Total debt has been coming down recently for the past few years, which is good to see. Last 12 months is around 100 million. So overall, for Copart, they have strong gross margins and other margins. They have a nice debt to equity ratio at 0, but there are some concerns for me that would prevent me from buying this company. Those are, what is the future of autonomous vehicle? And if you believe in the autonomous vehicle scenario and narrative, then you believe that those are going to be a larger and larger portion of the cars on the roads today. And that's not going to be good for Copart. Those vehicles won't be going through Copart's technology to get so that they can get the transaction fees for their revenues, to increase their revenues, increase their earnings. So that's a big concern that I have. Another concern I have is looking at their financials. I see a lot of stock-based compensation and no reduction of their shares outstanding. So as a long-term value investor, I'm not getting a good deal in a reducing share count, which will be increasing my total ownership of this company, which is, it's not happening. It's actually the reverse, and I'm getting diluted in this company. I don't like. So those two factors prevent me from buying this name, and I won't be adding this to my public portfolio. Now that's it, guys. If you like this content, please like and subscribe. And if you have other comments about Copart and why it should be added, let me know in the comments down below. And with that, I'll see you guys in the next one.